Is Amazon a buy at 214 per share? And if you want to build indestructible generational wealth, is Amazon a good choice as a long-term investment? The only way to know is via fundamental analysis to find the intrinsic value. I spent the last week putting together a full fundamental analysis of Amazon based on their recently reported 2Q25 results. Trading at 214 per share, I currently have a buy rating on Amazon stock. I personally own the stock, and I think that the post-earnings pullback provides an entry point, and it won't last long. I'll tell you exactly what to do later in the video. In my research, I discovered 7 things that got me really excited and 6 red flags to watch out for with Amazon. So what did I discover? What's my value for Amazon stock? And what's an ideal entry point should you decide to become an Amazon shareholder? I'm Ken Freeman. I have 20 years of Wall Street experience in investment banking and hedge funds, and I train the world's top financial analysts on Wall Street. In this video, I will cover Amazon's recent results and what everyone is missing, what I think about Amazon stock and what my analysis uncovered, what Wall Street smart money says and how it can impact your portfolio, and how you can use this information to build wealth and what you must do if you decide to buy. If you're enjoying this, please smash that like button. Amazon beat expectations across the board, but Q3 operating income guidance caused the stock to take a hit. Let's cover the red flags first. Amazon beat Q2 estimates, but its third quarter operating profit came in well below Wall Street consensus. The weak outlook triggered a 7.7% drop in the shares the next day.
Q3 operating income is expected to be between $15.5 billion and $20.5 billion. In this dynamic environment, we'll focus on what matters most, delivering exceptional customer value through broad selection, competitive prices, and unmatched convenience.
CEO Andy Jassy highlighted uncertainty around new U.S. tariffs, which could lift Amazon's costs, but that has not been seen yet. Extra import duties would squeeze margins just as CapEx is already rising.
There continues to be a lot of noise about the impact that tariffs will have on retail prices and consumption. Much of it thus far has been wrong and misreported. As we said before, it's impossible to know what will happen, but what we can share is what we've seen thus far, which is that through the first half of the year, we haven't yet seen diminishing demand nor prices meaningfully appreciating. The customers are advantaged shopping at Amazon because they're more likely to find lower prices on the items they care about.
Andy Jassy said that AWS has more demand than we have capacity right now, constrained by power and chips. He warned that it may take several quarters for supply to catch up, potentially capping near-term growth.
As I mentioned, well, we have more demand than we have capacity at this point, and I think that, and you see, some of the constraints, they kind of exist in multiple places. The single biggest constraint is power.
Analysts warn that AWS still lacks a marquee generative AI model, stoking fears that Amazon is falling behind Microsoft's OpenAI and Google, despite its multi-billion-dollar AI spend. One fund manager called the results alarming, saying that AWS must prove it can monetize AI or its heavy CapEx will keep dragging on margins and the share price. CFO Brian Olsavsky said that roughly half of AWS's quarter-to-quarter margin dip came from the seasonal step-up in stock-based compensation tied to its annual pay cycle. Stock-based compensation does nothing to positively impact the company's operations.
The largest quarter-over-quarter driver of the decrease, or about half, is due to the seasonal step-up in stock-based compensation expense, driven by the timing of our annual compensation cycle.
Management said full-year CapEx could hit $118 billion if the company keeps spending at Q2's $31 billion quarterly pace. Record CapEx raises the bar for future expected returns and free cash flow growth. Here's what got me really excited. Q2 EPS of 168 came in 26% higher than Wall Street expectations of 133. Amazon even exceeded their own expectations with operating income of $19.2 billion, $1.7 billion above their own guidance.
Worldwide operating income was $19.2 billion, which was $1.7 billion above the high end of our guidance range.
Amazon overall posted $18.2 billion of net income, up 35% year over year. Strong cloud and retail margins powered the all-time high. Shoppers saved billions across 35 product categories. 4-day Prime Day was Amazon's largest ever yet. Record sales and items sold.
This year's Prime Day was our biggest ever, with record sales, number of items sold, and number of Prime signups in the 3 weeks leading up to the Prime Day. Customers saved billions of dollars, and independent sellers, most of which are small and medium-sized businesses, saw their best sales performance of any Prime Day event yet.
Q2 cloud revenue jumped 17.5% year over year to $30.9 billion. Growth is picking up again. AWS also delivered $10.2 billion of operating income, approximately 33% margin, its biggest quarterly profit ever.
AWS grew 17.5% year over year and now has over a $123 billion annualized revenue run rate.
AWS operating income was $10.2 billion. We did see AWS segment margins decline from a record high of 39.5% in Q1 to 32.9% in Q2.
Direct lane shipping was up 40% year over year, sending packages straight from fulfillment to delivery without extra stops, speeding up orders. Average package travel distance cut by 12% and handling touches down 15%, lowering costs, boosting customer satisfaction, and expanding margins.
In Q2, we increased the share of orders moving through direct lanes where packages go straight from fulfillment to delivery without extra stops by over 40% year over year. We've also reduced the average distance packages traveled by 12% and lowered handling touches per unit by nearly 15%.
Online store sales grew 11% year over year to $61.5 billion, showing that consumers are still clicking buy despite tariff concerns. Let's face it, where will you find lower price online for everyday needs than Amazon?
With online shopping and overnight delivery.
This is what everyone is missing. Q2 advertising revenue soared 23% year over year to $15.7 billion, handily outpacing retail and cloud growth. The high margin ads engine diversifies Amazon's profit mix beyond AWS and e-commerce.
Moving on to Amazon Ads, we're pleased with the strong growth, generating $15.7 billion of revenue in the quarter, growing 22% year over year.
When it comes to any stock, I let the numbers tell the story, and that involves looking at the company's financial statements. Would you buy a house without knowing the size, dimensions, location, or condition?
No thanks.
That is what you are doing when you buy a stock without understanding the three financial statements. If you want to see how I teach the world's top financial analysts on Wall Street, check out my school community, Win Like Wall Street. Just scan the QR code on the screen. The balance sheet shows us how the business is funded. If assets grow faster than liabilities, equity increases, and we win. At year end, Amazon had almost $79 billion of cash. And if we combine that with cash invested in securities, it's over $101 billion. At the end of 2Q, it's still an impressive $93 billion. And they are currently net cash, which means cash is greater than debt by over $42 billion. Imagine if every dollar of debt that you had, you were also sitting on $2 of cash. That is Amazon. This gives the company a stockpile of cash to invest in the future, including AI infrastructure, delivery optimization, and their rapidly growing cloud business. Retained earnings increased over 50% in 2024 and through 2025. Other than Tesla, Amazon is the only other Mag 7 company that does not pay a dividend, which boosts its retained earnings. Part of Amazon's secret sauce, going back to Jeff Bezos, is to plow as much capital back as possible into the business. All right, here come the gems. While marketable securities doesn't stand out, that is where Amazon's $4.6 billion investment in Rivian is. They own 18% of the company. Amazon has invested heavily in Anthropic, the company behind Claude, which is a competitor to ChatGPT. And that investment is now worth $13.8 billion, and it's captured in other assets. It pays to read the financials. It's kind of like a treasure hunt. What do you think about Amazon's investments in Rivian and Anthropic? Let me know in the comments below. So what's the takeaway? Amazon has tons of cash, its debt is declining and manageable, and it's substantially growing retained earnings. The income statement shows us if a company is generating profit. We want to see revenues grow faster than expenses, which will grow profits. The way we determine how effective a company is at generating profit is via margin. Revenues minus expenses equals income, income over revenues equals margin. If a company has higher revenues and lower expenses, it will have higher margins. If revenues grow faster than expenses, margins will get bigger or expand, which is what we want to see. Last year, Amazon generated a massive $638 billion in revenue, with 42% coming from online and physical stores. As of 2Q25, advertising and AWS make up almost 28% of total revenues, and that share continues to grow. Revenue grew 11% in 2024, which is remarkable for a company with over $600 billion in revenues, and it's anticipated to continue growing in the low double digits over the next 5 years. Margins expanded across the board, which is a tremendous positive, showing operating efficiency even with high revenue growth. Gross margin is almost 52%, and operating margin is almost 5x what it was in 2022. And net margin has also expanded massively. This shows that the company is efficiently managing costs, which is a great sign for investors. While net income fell in 2022 due to a one-time write-off of Rivian, see Other, it grew almost 95% in 2024. Amazon is growing revenues faster than expenses, which means more money falls to the bottom and in the pockets of investors. So what's the takeaway? Over the last 5 years, net income has grown more than double the rate of revenues. This is a win-win for investors and shows incredible operating leverage and efficiency at Amazon. The cash flow statement tells us where the cash is generated by the company, and there are 3 buckets. Operating, which is the cash the company generates internally, investing, which is the cash demanded for long-term growth, financing, which is the cash the company generates externally. When we add these together, we get the net change in cash. We want to see companies generating cash making this positive, not losing cash, which would make this negative. Operating cash flow is positive and growing rapidly. Operating cash flow increased nearly 31%, primarily driven by the strong net income that Amazon is generating. As I mentioned earlier, Amazon is the only Mag 7 company other than Tesla to not pay a dividend, but they did return $6 billion to shareholders in 2022, and they have another $6.1 billion remaining under the share repurchase program. Jeff Bezos became known for reinvesting back into Amazon to grow the company, and Andy Jassy has carried the torch. This is the secret behind how Amazon has become one of the most valuable companies on earth. Pay close attention because I mentioned something earlier about Amazon that is unique amongst the Mag 7. Well, here it is. Sales and maturities of marketable securities was $163 billion over the last 5 years. This is the money that Amazon is making from its invested cash. What is truly unique is that they made over $25 billion in acquisitions over the last 5 years, such as MGM Holdings for the digital media content and One Medical to provide healthcare options. This means that they are using what they generate from invested cash to buy companies. Imagine you had money in the bank and you used interest to buy companies and build your empire. The best part is that you aren't even using the original cash, just the interest generated, so you are compounding like crazy. So what's the takeaway? Amazon is using the returns generated from its cash to buy great companies, and it has money left over to invest in AI innovation, delivery optimization, and continued growth in the AWS cloud business. So what do I think about Amazon, and what should you do? I'll get into that, but first, let's go through my valuation. On Wall Street, we build a discounted cash flow model to measure the intrinsic value of companies. Because companies generate cash flow and we projected the 3 financial statements, we could take these future cash flows, discount them back to today to get a current intrinsic value of the company. We cannot do this type of valuation with crypto, baseball cards, or art because they have no cash flow. If you want to learn how to build financial models just like we do on Wall Street, scan the QR code on the screen to join my school community, Win Like Wall Street. Also, you could check out the step-by-step video I did on building a DCF model, which includes an Excel file. The link to that video appears above and is in the description. As you can see on the left, we take specific line items that we projected from the 3 financial statements. We use these line items to calculate free cash flow to the firm, or FCFF. To this, we add a terminal value, which is the value from the end of the model out to infinity, because the company does not stop operating when our model ends in 5 years. We discount these cash flows back to today to get to total enterprise value. To get to equity value, we strip out the debt, we add the cash, we strip out non-controlling interest, we add associate investments. We get an intrinsic equity value of over $2.7 trillion. We divide by the current shares outstanding, we get an implied share price of $256.29. Compared to the current close, that's a 19.9% discount. Although it says hold, this is a buy rating. On Wall Street, if a stock is trading at greater than a 20% discount, it's considered a buy because it provides a margin of safety. I'll give you my thoughts on how to play Amazon stock later in the video. So what does Wall Street have to say about Amazon? Let's cover that next.
Let's see it.
While Wall Street was underwhelmed by the Q3 operating income guidance that Amazon provided, the consensus is that Amazon is well positioned to manage tariffs, grow e-commerce, AWS, and advertising. Jefferies maintained a buy rating with a target of 265, arguing that tariff concerns have been overstated, consumer demand remains resilient, and AWS is emerging as the preferred platform for complex AI workloads, supported by strong e-commerce and advertising growth. UBS reiterated a buy rating and raised its price target from 249 to 271. UBS called Amazon the most coiled big tech stock due to its extensive investments across e-commerce, AWS, advertising, and Project Kuiper. We'll get into this later. This positions it for dramatic operating profit and free cash flow upside as those businesses scale. Morgan Stanley upgraded Amazon to a top pick, setting a $300 price target with a bull case of up to $350. They cited improving macro conditions, declining tariff risks, and sustained strength in both e-commerce and AWS as drivers of multi-year upside. CapIQ gives me a sense of how other analysts on Wall Street view the company. 63 analysts cover Amazon on Wall Street. The target price ranges from a low of 209, which is a 2% decrease, to a high of 306, which is a 43% increase. Upside outweighs downside by over 21x, 43 up versus 2 down. Hedge funds typically look for 2 times and above. This is the greatest upside to downside that we have ever seen on this channel. The median is 260, which is a 22% increase. The overall rating on a scale of 1 to 5 is 1.32, which is a buy rating.
You should seek the advice of an investment professional always. I do not know your individual financial situation. This content is meant to educate and is not investment advice.
That being said, I do own a position in Amazon. I actually increased it during the tariff craziness. It is currently 4.9% of my overall portfolio. I'm a big believer in the company, and I'm planning on building my position as a result of this analysis. If you decide to buy Amazon, I'll tell you exactly how to build a position, including the ideal entry point, which I'll reveal shortly. The new $140 million Kennedy Space Center site can run 3 launch campaigns at once. The facility will process over 100 satellites per month as Amazon speeds its global internet consolidation.
We've recently completed our 3rd successful launch of Project Kuiper. We haven't launched this service commercially yet, but already have an impressive amount of enterprise and government customers who have signed agreements to use Kuiper.
More warehouse robots are coming online. This will speed up deliveries and cut costs. Smarter Alexa AI features and the Project Kuiper internet service launching in late 2025 promise new perks for customers. Management guided Q3 net sales to $174 to $179.5 billion, topping analyst estimates, which was $173 billion consensus. The upbeat outlook suggests confidence in the summer quarter and back-to-school deals.
Q3 net sales are expected to be between $174 billion and $179.5 billion.
Despite having $638 billion in revenues in 2024, Amazon is growing in the low double digits. Margins are the highest that they've ever been. And also, Amazon keeps reinvesting in the future, which continues to grow value for shareholders. While we typically think about Amazon as a product delivery company, the massive growth in advertising revenue provides another strong and growing revenue stream, which is a high margin service rather than a low margin product. Amazon hit a 52-week high of 242.52 in early February of 2025, and it's down almost 12% since then. Despite delivering incredible financial results, the stock has traded down as analysts question the operating income guidance for Q3. I see this as a very short-term buying opportunity. Just like Prime Day, this deal won't last.
I gotta hurry, Mom.
My model shows a value of $256.29, which is a 19.9% discount at current levels. Let's call it 20% amongst friends. On Wall Street, we buy with a margin of safety of at least 20%. So Amazon is a buy at current levels, but I would be looking to buy below $213.50. Even better if you can get it below $210, but don't split hairs. Amazon is a forever type holding that you buy and don't touch, and right now is a great entry point. I order from Amazon multiple times per week, and it's the only company that I can say I do business with consistently without fail. The low pricing, convenience, and simplicity make it a no-brainer. How often do you order from Amazon? Let me know in the comments below. If you like this and want to see another in-depth stock valuation, check out my Alphabet video here or my Albertsons video here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.